Picture this, you're finally making 100 grand a year. Not that long ago, a six-figure salary was the absolute peak of the American dream. It meant total financial security, a beautiful home, and plenty of money in the bank. But today, mid-2026, you could be making exactly that amount and still feel, well, completely broke. It's wild, but it's the reality for millions of Americans right now. In this explainer, we're going to dig into the hidden economic divide that's literally draining your wallet from the inside out and completely reshaping our society. Let's dive in.
So here's the multi-million-dollar question. On paper, the U.S. economy looks unstoppable. The Atlanta Fed's GDP Now model says we're tracking a really solid 3% real GDP growth for the second quarter of 2026. Money is moving, the economy is expanding. But if the national pie is getting bigger, why does it feel like someone else is eating your slice? Why are everyday folks, even higher earners, feeling so incredibly squeezed right now?
Well, it comes down to this massive, frankly crazy disconnect between Wall Street and Main Street. If you just look at the headlines, everything is awesome. 3% GDP growth, a raging bull market driven by corporate earnings. But down here on the ground, totally different story. When you actually factor in the cost of living, real wage growth is literally in negative territory. Your paycheck buys less today than it did yesterday. Everyday consumers are just falling behind, and that's sparking these stubbornly high delinquency rates on auto loans and credit cards. It is basically a tale of two entirely different economic realities happening at the exact same time.
To wrap our heads around why this is happening, the financial experts at Charles Schwab point to something called a K-shaped economy. Just picture the letter K. You've got this vertical line where we all start, and then, boom, the paths violently split. The top arm of the K, that's the part of the economy that's accelerating, just hoarding massive wealth and riding that bull market to the moon. But that downward arm, that represents pretty much everyone else. They are facing intense pressure, negative real wage growth, and rapidly shrinking purchasing power. Depending on which arm you're on, you are living in a totally different version of 2026.
And we actually have fresh data from Equifax's 2026 Wealth Trends Report showing exactly who is sitting where on that K. Look at the bottom, the mass market. That's 71 million households sharing just $1.5 trillion in total assets. Step up one level to the mass affluent, where our $100,000 earners usually hang out, and you've got 47 million households holding $19.5 trillion. But then you look at the top tier, the affluent. Get this, just 14 million households control an absolutely staggering $53.4 trillion in total assets. It's wild. This tiny group at the top is driving all those flashing economic headlines, while everyone else is literally taking on debt just to maintain a baseline lifestyle.
50%. According to Charles Schwab's mid-year outlook, the consumer savings rate right now is roughly half of what it was right before that massive 2022 inflation spike. I mean, people are just burning through their safety nets. If you're sitting there wondering where all your money went, well, it's being quietly swallowed up by a cost of living crisis that's forcing you to drain your savings just to keep your head above water. The average household has honestly never been this vulnerable.
So what exactly is secretly draining that wallet so fast? A lot of people think inflation is defeated, right? Well, actually, supercore inflation, which tracks core services, is stubbornly stuck above 3%. And the main drivers here are fascinating. You know that massive global AI boom everyone's hyping up? It's actually keeping your costs high. Capital expenditures for AI, especially software, carry a ton of weight in the Fed's preferred inflation gauge. So ironically, the exact same AI boom making the stock market filthy rich is contributing to the sticky inflation eating away at your paycheck. Kind of a crazy plot twist, right?
But hey, it isn't just tech. We've also got unexpected global events acting like a hidden tax on your daily life. The Schwab Outlook highlighted a major wildcard that caught everyone totally off guard this year, the conflict involving the US and Iran, leading to the effective closure of the Strait of Hormuz. This geopolitical standoff has caused energy inflation to just absolutely spike. And you know the drill. When energy costs shoot up, literally everything else from the truck delivering your groceries to your morning commute becomes dramatically more expensive.
Now at this point, you might be thinking, okay, if things are so expensive, I'll just go get a better paying job. But here is the trap of 2026. We are stuck in what economists call a low-hire, low-fire labor market. Sure, the overall unemployment rate is stable, meaning mass layoffs aren't really happening, which is great, but if you look under the hood, the hiring rate is hovering near a multi-decade low and job postings are completely flat. So you aren't getting fired, but nobody is hiring either. That means you have absolutely zero leverage to demand a raise to fight off that sticky inflation. You are just financially stuck in place.
And this brings us to a really fascinating contradiction in the data.
See, the Federal Reserve's official stance in their financial stability report is that household balance sheets are strong, pointing out that most debt is held by borrowers with excellent credit. Okay, great. But right next to that, we have this harsh consumer reality. Auto loan and credit card delinquencies are remaining at stubbornly high levels. How can both things be true? Well, remember the K-shaped economy? The top tier has immaculate balance sheets, while the folks in the middle and bottom are literally defaulting on their cars and credit cards just trying to survive the month.
Trying to manage this crazy balancing act has forced the Federal Reserve to play a really dangerous game with interest rates. Let's rewind a bit. After jacking rates way up in 2022 and 2023, the Fed finally threw us a bone and started cutting them in 2024 and 2025. But by June of 2026, the music stopped. The Fed became highly divided and decided to hold rates completely steady at 3.50 to 3.75%. Why? Because of those exact inflation risks we were just talking about. The AI demand, the soaring energy costs, they literally can't afford to lower rates to help you because they're terrified of sending inflation spiraling out of control again.
And the most painful real-world consequence of this Fed pause is hitting the housing market, 6.5%. That is the current mortgage rate as of June 2026. Now here's a little secret. Fixed-rate mortgages don't actually track the Fed funds rate directly. They track the 10-year Treasury yield. So even back when the Fed was cutting rates, mortgages stayed stubbornly high. And today, a 6.5% rate means that if you even attempt to buy a home, a huge chunk of that $100,000 salary is instantly devoured by interest payments.
This dynamic creates the ultimate financial divide. Look at this data straight from the Federal Reserve tracking housing leverage. Basically, how much debt homeowners carry compared to their home's value. It's actually staying significantly below the peak levels we saw back in the mid-2000s. So what does this mean for you? Well, if you bought a house years ago, you are sitting on a massive equity cushion. You are insulated. You're cruising on the upward arm of that K-shaped economy. But if you're a new buyer today, staring down 6.5% rates and crazy high prices, that exact same protective barrier keeping older homeowners safe acts like an impossible brick wall financial hurdle for you.
Bringing this all together, the Federal Reserve themselves completely acknowledged this tense environment. In their June 2026 meeting minutes, they laid it right out there, stating participants generally assessed that upside risks to inflation remained elevated. Basically, officials are warning us that surging AI demand, conflicts in the Middle East, and potential tariffs might actually force them to raise interest rates again. So yeah, the strain on your household budget, those expensive borrowing costs, the high cost of living, they aren't just temporary blips. They are likely here to stay. So, as we've seen throughout this explainer, those flashy top-line GDP numbers in a booming stock market can easily camouflage a pretty grim reality of negative real wages, drained savings, and mounting debt. You aren't crazy. You aren't imagining the squeeze. The data absolutely proves it is real. So the question I want to leave you with today is this. With AI quietly driving up everyday costs and borrowing locked at these painful highs, how are you going to adjust your own financial strategy to survive and hopefully thrive on your side of the K-shaped economy? Thanks so much for joining me today, and as always, keep questioning the headlines.